So I'm not Rick Rule, I'm not Willem Middelkoop. Tough competition. I'm just Ronny Stöffele, and in the next 20 minutes I'll give you a brief overview about the stuff that I'm thinking about, the stuff that I'm excited about. The leitmotif or the title of my speech is The Big Long, Under-Owned, Underestimated and Unfinished. Who of you read our last In Gold We Trust report? There's a few. Page 422. Jim? Okay. Now we're already working on the next report. Will be published on May 20th. It's going to be the 20th annual In Gold We Trust report, and the title will be The Next 20 Years. So we really focus on the big picture. But let's talk about gold first. Since 1971, ladies and gentlemen, the world's been in a grand monetary experiment, the fiat era. One asset has stood apart, gold. Gold's CAGR since 1971 is 9.4%. 9.4% annual performance. But what do the asset managers in traditional asset management tell you? What do the CFAs tell you? People that are trained to worship modern portfolio theory, they tell you that gold is a pet rock, that gold is useless, that gold doesn't pay any interest. Because their models, their religion, modern portfolio theory is telling them, well, actually, gold is not an efficient portfolio part. Gold is something that doesn't pay any interest, where you cannot calculate the value. But ask those experts a few simple questions. Ask them about inflation cycles. Ask them about monetary history. Or ask them the most fundamental question, which is, what is money? And you'll get blank stares. And this is exactly where we are at the moment. This brings us to the heart of my presentation. Because the old investment playbook is breaking down. The 60-40 portfolio relies on one assumption, and the assumption is bonds, hedge, stocks. Well, in an inflationary world, that hedge obviously fails. Bonds aren't a stabilizer anymore. Bonds have become a dead weight for your portfolio. So this reliable stock-to-bond correlation, it's actually the exception, it's not the rule. Over the last 100 years, stocks and bonds moved together 70% of all the time. So why did the traditional 60-40 portfolio actually work? Because we lived through the so-called Great Moderation. 2 decades where people couldn't care less in their portfolio construction about inflation volatility. But that era is over now. From my point of view, ladies and gentlemen, the portfolio's former safety anchor is the bubble itself. Now people ask me, where is the future demand for gold coming from? It's pretty easy, fixed income. That's a 160 trillion asset class. And I can tell you that even small reallocations to gold and hard assets will make a big move in the gold space. Now, I was lucky to have some really great mentors in my career. And one of them gave me this advice. And I wrote it on a post-it and put it on my monitor, sitting on my desk. Scare your investors out of bonds. Now, as it often happens, this mentor, he was pretty early. He didn't see that actually we would see 21 trillion of government debt with negative yields. He didn't see that the bond future would go to 160. So he was early. He was way too early. Back then, bonds were safe, yields were low, central banks had everything under control. But now, it's finally happening. Inflation is here, and bonds are now finally exposed. They're not a risk-free asset anymore. And this brings us to this new 60-40 portfolio that we introduced in our In Gold We Trust report 2024. We said the new 60-40 portfolio should actually be 45% stocks, 15% bonds, primarily, I would say, debt from emerging markets, corporate debt, 10% what we call performance gold, 10% commodities, and 5% Bitcoin. So this is our strategic allocation. So as you can see here, we've got performance gold and safe haven gold. Gold plays a double role. Safe haven gold, that's physical gold, stored outside of your jurisdiction, outside of the banking system. It simply sits in your portfolio as a strategic monetary insurance policy. And then there's performance gold. What's performance gold? That's gold and silver mining equities. But don't mix up both. I think for mining stocks, as we all know, you have to be an active investor. You really have to follow the news. You have to follow the market. So performance gold, from our point of view, has to be actively managed because the volatility is extremely high in the sector and leverage cuts both ways. Not only Incrementum is reconsidering the 60/40 portfolio, but also a company that is slightly larger than Incrementum, which is Morgan Stanley. They suggest a 60-20-20 allocation, 60% equities, 20% bonds, and 20% gold. Who would have thought 2-3 years ago that Morgan Stanley CIO would say 20% gold holding? But have a look at this chart. Great chart by Bank of America. And it shows us that 60/40 doesn't blow up, it actually bleeds out. Most of the time, you get smooth compounding with 60/40. But every few decades, you've got a couple of years, a decade, and you can see it in red, where you've got long, flat, and frustrating returns, often after inflation shocks, wars, or a valuation excess. And as you can see here, well, actually, this only started in 2022. So we're now still in the early stages of this new 60/40 portfolio. And we crunched the numbers, and actually the new 60/40 compared to the old 60/40, it gives you 25 percentage points of pure alpha since mid-2024. 25 percentage points. So the new 60/40 portfolio actually really works in real time. Now, is gold a contrarian asset anymore? No. I mean, compared to 1 or 2 years ago here at VRIC, obviously, everybody is excited, everybody is optimistic. From my point of view, we're not at the beginning of this bull market. We're somewhere in the middle, let's say in the second half of this bull market. However, gold is still vastly underowned. Have a look at this chart, it's by Goldman. Gold ETFs currently account for 0.17% of private US financial portfolios. 17 basis points. That's 6 basis points below the 2012 peak. It doesn't look like a bubble. Have a look at this chart, UBS, based on the numbers end of 2024. Family offices hold 2% in gold and precious metals. Commodities, less than 1%. And I can tell you from my daily experience, pension funds keep calling us and say, well, actually, we're getting nervous. We're having now a 3% allocation to gold. We have to sell down a little bit, yeah? It's giving us sleepless nights. So, ladies and gentlemen, this is the standard allocation of a family office. I know some of them that feel like really bold, having 5 or 6% physical gold holdings. But this is telling me, well, actually, we're not at the end of the secular bull market. This is my very favorite chart. It shows the relative development of gold versus the S&P, silver versus the S&P, gold stocks versus the S&P, and the Bloomberg Commodity Index. And our thesis in our last In Gold We Trust report was, gold always goes first. Then at some point, silver breaks out and starts outperforming, and then it's the time of commodities. And this is exactly playing out. Well, gold moved first, silver followed, mining stocks are now finally following, but what's missing is commodities. And from a risk-reward perspective, I'm actually much more optimistic on commodities than I am on gold at the moment. Have a look at this chart. It shows ETF market share of commodity ETFs versus all ETF assets. That's 3% now. Well, this is mainly driven by the development in precious metals. Commodities ex precious metals is only 0.2% of all ETFs. And it's kind of stabilizing, but we don't see any major excitement, any major flows into commodity ETFs yet. Energy, 2.8% of the S&P 500. Can oil go lower? Absolutely. If we hit a recession, definitely. But if you have a look at the price of the development of some of the oil field companies, of some major oil companies, they're already doing pretty well. So from my point of view, the risk reward in the energy space is outstanding at the moment. And then you've got the sentiment. Sentiment in commodities is at best neutral. Actually, nobody really cares about commodities. And I can tell you, being from Europe, ESG was the big trend. If you go to a fund management conference in Europe, you felt like at a Greenpeace convention. Everybody was about ESG, sustainability, everybody was really green. And that also meant that all the institutional asset managers, they got rid of everything that has even close ties to commodities, because commodities are dirty. Commodities are something negative. So you don't see any allocations with institutional players when it comes to commodities. So I think there's going to be a big shift coming over the next couple of years. Now, what's the hard asset playbook? We're seeing core is gold, obviously. If you want convexity, go for silver. And if you want leverage, go for the miners. Let's briefly talk about the valuation of gold. So gold is not dirt cheap anymore, as I've said. However, measured in S&P 500 terms, so basically how many ounces of gold it takes to buy the stock market, we're still somewhat undervalued. And have a look at this red line here. For some reason, this 1.6 ratio is important. And we're now exactly at this ratio, 1.6. And there's been a couple of times when actually we went below this 1.6. There was a big move coming. First of all, higher gold, lower stocks, or both. And what's also pretty interesting is, quite often actually, when we saw that move below 1.6, we entered a recession. Bank of America fund manager survey, who believes in a hard landing? Recent survey, 0%. So I don't really forecast a recession, but I think there should be at least some discounting of a recession going forward. And perhaps this chart is telling us that. Now, how does it look if we compare the market cap of gold to the market cap of US equities? I think that's a really good chart by Charlie Morris. At present, gold's market cap is just 38% of the market cap of US equities, which is exactly the long-term median. And that's a far cry from the 160 that we saw in 1980 or in the 1930s and 1940s, but even lower than in 2011, for example. So, ladies and gentlemen, secular bull markets, they don't end at median values. They end at extreme values. Have a look at this chart. Subotrade, very interesting. They crunched the numbers and said, well, actually, gold has outperformed the S&P 500 6 months in a row. That's the longest streak since the great financial crisis. So what happened next when we had such a development? Well, as you can see, 7, 8, 9, 10, 11 months or 1 year later, actually the performance of gold, basically in every instance, was positive. So now we're really seeing this development where gold starts outperforming the S&P 500, and people tend to underestimate momentum. Once we have momentum, sometimes you cannot stop it. So This makes me pretty confident for the next couple of months when it comes to gold. Now the big question, and I said it at the beginning this morning, are we in a normal cycle, or are we at the beginning or in the middle of a revaluation of gold? So is gold in monetary terms, is it too expensive? Have a look at the so-called shadow gold price. What would gold be worth if the monetary base were backed by gold? So with a 25% backing, price of gold would have to be 5,400. 45% backing, 8,600. 100% backing, 21,000. Now, history rhymes, ladies and gentlemen. Twice in the last century, the early 40s and around 1980, the market value of official US gold reserves covered more than 100% of the US monetary base. We had that twice in the last century. So if every 40 years gold coverage has surged toward parity, if it happened before, why not again? This is a great chart by VRIC. They did something similar. They said, well, actually, what would the price of gold be if you want to equalize the M0 monetary aggregate? Well, good news for Kazakhstan and Russia. Their monetary base is actually more than 100% covered by gold. Bad news for Japan, the UK, United Arab Emirates. They would need significantly higher gold prices if there would be some sort of a monetary revaluation. And again, this is the big question. Are we going back to some sort of gold backing of our currencies? Now let's briefly talk about miners. Well, they're actually waking up. However, money is still leaving the ETFs. Have a look at the GDX flows. That's GDX and GDXJ. We've actually seen 2 years in a row of outflows. This is not how a bull market usually ends. Have a look at this chart. I love it. It's showing a ratio between the GDX and the GLD. So basically, GDX, the mining stocks, only recently started outperforming gold itself. And then the upper one in blue, that's the outperformance of GDX, so large caps versus small caps. So there's a big gap. And normally, in every major trend, the leadership is defensive. Large caps over juniors, and then when liquidity kicks in, the small caps at some point really start outperforming the large caps. And this has only recently started. Let's briefly talk about silver. In 2020, we came out with our gold report where we forecasted our base case scenario by 2030, which was $4,800. Back then, people said we're crazy. This is outlandish. We said in an inflationary scenario, we could see 8,900 as our target. Well, just run the gold-silver ratio at 8,900. Now, I know that 8,900 still sounds pretty far-fetched. However, that is a 12.3% CAGR from now until 2030. 12.3% every year. I think that's actually kind of conservative. Now, if we would go back to a gold-silver ratio of 40 at 8,900, that would mean a silver price of 223. And a gold-silver ratio of 10, well, 819. That's not my official forecast. But I wouldn't say it's impossible, because actually every major gold bull market ends with a gold-silver ratio between 10 to 15. So I wouldn't rule it out. However, to be honest, in our funds, we've become a little bit more conservative recently. From my point of view, at some point in the next couple of days, next couple of weeks, we'll probably see a bigger correction, 15 to 20%. Don't be scared. Corrections are something normal, something healthy. But the general sentiment, I have to tell you, is extremely positive, extremely bullish. So therefore, be cautious, don't be greedy. The next couple of weeks could give you tremendous buying opportunities. And again, our long-term forecast at the end of this decade, it's $8,900. And from my point of view, we are right on track for that. Thank you very much for your attention. 20th of May is the next In Gold We Trust report. Thank you very much.